Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. It's tariff day. It's hitting in a big way. The S&P 500 down about 3.3% pre-market, the Nasdaq down about 4%, oil down almost 5%, the 10-year down as well. Asian stocks down about 2%, European stocks down about 2% as well. So everybody is being hit with this announcement of tariffs that was known. People knew it was coming, but I think people are surprised by how big it is and how weirdly calculated it is as well. There's a clear focus on U.S. goods trade deficits here. The administration feels like that's led to the hollowing out of our manufacturing base, which is definitely true. That's certainly shrunk in the last 20 years, undermines critical supply chains, and renders us too dependent on foreign adversaries. And the definition of foreign adversaries is a bit unclear because everybody is getting at least a 10% tariff here. They have excluded Russia, North Korea, a few other countries that have a lot of sanctions and or tariffs already. But at the end of the day, even if you have a trade surplus, you're still getting a 10% tariff in this setup, which is kind of weird in a way. Beyond that, the tariffs get higher as your trade deficit gets higher as well. And these tariffs are going to remain in effect until such a time as President Trump determines that the threat posed by the trade deficit is mitigated or resolved or whatever, which again gives a lot of power to a guy that a lot of people don't seem to like these days. And as you look at these tariffs, this sheet that they showed during the presentation kind of makes it seem like, hey, these are the actual tariffs that these countries are charging to importers who are bringing in goods from the United States. And maybe if that were true, then these reciprocal tariffs would kind of make sense because we're essentially saying, hey, whatever the tariff on this sheet is, we're cutting it in half, and that's what you're getting charged. If the number is 10%, you're getting that minimum 10%. The problem, though, is that these aren't the actual tariffs that are being charged. These are basically a deficit ratio that they're using to calculate the tariff that includes currency manipulation and trade barriers that you see in small text here. And they're a comparison of the trade balance that exists between the countries divided by the US imports. You can see that data here from the census. In the 2024 data, we have 143 billion in exports with China and 438 billion in imports with China. So you were exporting 143 billion in goods, we're importing 438 billion in goods. That leads us to a negative 295 billion trade balance. And because of that, you have a 67% trade deficit ratio. And they see that as them putting a 67% tariffs on items coming in from the United States. And again, they're using the term tariffs charged to the USA. You still have to remember the tariff is a tax on goods being brought into a country. So that tax is paid to China by the importer. So it would make those items more expensive if it were an actual tariff, which it really isn't. It's just a comparison of the deficit between the imports and the exports within that country. So if you have a trade balance that's negative, you have a deficit. And if you have a trade balance that's positive, like the UK does, or the Brazil does, or Australia does, you have a surplus. But even in those situations, you're getting a 10% reciprocal tariff because that's the minimum. And that's kind of a weird way of doing it because these aren't real tariffs. You can make it seem like they're real tariffs, but when I'm sending stuff to Vietnam, maybe in certain situations there's a tariff on it, but on average, there's no way that there's a 90% tariff on those items. When I'm sending stuff to South Korea, a country with which we have a free trade agreement with, there's no way there's a 50% tariff on average. That's just nonsense. The reality is that these trade deficits are driven by the fact that the United States doesn't produce that much stuff anymore. We've become a service-based economy, which may or may not be a good thing. In the eyes of Donald Trump, it's a bad thing. But the reality is that other countries are making stuff that we want to buy, so we import it, and we don't make that much stuff that other countries can import from us, so we don't have as many exports. For example, when you look at Vietnam, a lot of manufacturing has been moved to Vietnam and other countries like it from China once those Chinese tariffs happened in 2018 because it was seen as a safer haven than China. And now the US imports there are very high because companies like Nike, like Lululemon, like Deckers, etc., make a lot of apparel there. That apparel comes into the United States and we buy it. And in reverse, we're just not making that much stuff that's affordable to the people in Vietnam. So we're not exporting a lot of stuff there. So because we have a large deficit, suddenly this is showing that we have a 90% tariff for Vietnam, and we're going to reciprocate by putting a 45% tariff on items coming in from Vietnam, which completely screws those companies that switch their production from China to countries like Vietnam, to countries like India, to countries like Indonesia, Malaysia, Cambodia. The reason those countries have such large deficit ratios is because a lot of production from American companies move there from China, and they just don't buy a lot of stuff from America because when we do make goods, they're expensive, and these countries don't have that much money. And the reality is that's driven by American companies. That's driven by American companies looking for ways to save on costs and to improve margins. It's not driven by a lot of those countries. So when you look at something like Vietnam implementing this 90% tariff on items being exported from the US, they're not doing that. They're just benefiting from the fact that American companies want to manufacture their things cheaply, want to avoid the tariffs that are in place in China, and are moving that manufacturing hub to Vietnam and are now importing a lot of stuff into the US because of that. And that could be a bad thing. I think that's the point that the Donald Trump administration is trying to make. When you look at these massive deficits in a lot of these countries, we are essentially supporting a lot of these economies by sending manufacturing jobs there, creating jobs there, and then buying a lot of these goods and supporting these other countries without getting any support from them in the form of exports from the United States. That's the point they're trying to make. And that can be hard to do. I mean, there's a reason why countries choose China or Vietnam or Taiwan or India to make a lot of their items. And that reason is that it's just a lot cheaper to do a lot of these things overseas. Salaries are a fraction of the salaries you'd pay in the United States. There's less government regulations, less welfare regulations, less environmental regulations. And these are not good things. These are bad things for the employees. And it's bad that the companies in the United States are taking advantage of that. But I'm not sure that something as small as a 45% tariff is going to change that. And that may be weird to say because a 45% tariff is quite high. But if you think about it, what's the solution for a company that's making stuff in Vietnam? Obviously, they can move it to another country that has a lower tariff. But with how in flux these tariffs are, how easy is that to do? It's certainly difficult to move your production hubs between countries and figure out supply chains, get materials, etc. They'll certainly figure out ways to minimize tariff impact, get materials from countries that are lower tariffs, maybe ship their items into different countries that have no tariffs between each other, and then finally ship those to the US or whatever. Or two, you could build a factory in the US. The problem with that, though, and I think this is obviously what the United States government wants, is that how expensive is that going to be? How long is that going to take? And is it just easier to eat the additional cost of the tariff and or more likely pass it on to the consumers, which leads to an increased cost for people who are buying shoes or materials or whatever it is they're buying from other countries? Certainly, some companies will choose to build out factories in the US. I think that will happen. I think there'll be some announcements in the coming future that says, hey, we're building a factory in the US. Yay, what a win. The question becomes, are they going to actually do that? It takes years for that to develop. And they're probably looking forward to, hey, what happens when the next administration comes in? What happens to these tariffs 2 to 4 years from now, when and if the Democratic Party wins the next election? That's one thing to keep in mind. These changes in manufacturing hubs, if they were to build something out in the US, that's not going to happen overnight. The other problem from a consumer perspective, when you are looking at an item that used to cost $20 for a company after they brought it into the US. It's now going to cost $30 for the company when they bring it onto the US and pay the 45% tariff to the government. What are they going to do with that cost? Are they going to eat the margin, or are they going to pass it on to the consumer? If they pass it on to the consumer, that means that your costs are going up, a decent amount, because the cost to bring the item to the US are now higher. That means the final price has to go up as well. Potentially leads to inflation, potentially leads to a slowdown in the economy if people can't afford certain things, potentially leads to a recession. All of these things have to be considered. Is there upside to tariffs? Probably. When you look at what their goal is, there's a trade imbalance, but that trade imbalance is certainly not simply based on tariffs. They talk about these tariffs here that, hey, if you look at the lowest simple average MFN tariff rates in the world, the US is at 3.3%, China is at 7.5%. So you have a 67% deficit with China, and the tariff on an average basis is 400 basis point different than the United States. So even if all of these tariffs came down to zero across the board, if everybody said we're not tariffing everybody at all, we're all at zero for every country in the world, I think the United States would still have a pretty massive deficit, because the United States is behind on certain things that makes other countries attractive as a manufacturing hub. And these things are good. The fact that we have environmental regulations, the fact that we have good work benefits, the fact that we have good salaries, these are good things for Americans. But these aren't things that other countries care about. And that's what makes American companies choose those other countries as manufacturing hubs. So I think the White House and President Donald Trump are kind of targeting these other countries as if they're doing something wrong. And maybe some of them are. There's certainly tariffs that should be cut. And I think in the near term, there's going to be some news that says that, hey, we're reducing the tariffs that we have on all of our items on the US to zero or whatever. And that's going to be touted as a huge benefit for the United States. But at the end of the day, I don't think that's going to matter, because I don't think it's tariffs that are driving the difference in deficit. It's other things that the United States can't match unless we want to strip away all workers' rights, unless we want to make jobs horrible to work in, unless we want to do a variety of other things that other countries are doing that make them attractive to businesses, but not attractive to workers. And yes, there are other things besides tariffs that are barriers to trade that I think other countries could get rid of. China is certainly protectionist in a lot of ways beyond tariffs. There's other burdensome things that other countries apply to not just the United States, but to other countries as well worldwide. But at the end of the day, I think even if you remove all those things, because we are a service-based economy and not so much a manufacturing-based economy these days, we're still going to have trade deficits. However, it would be beneficial if those trade deficits were reduced with the reduction of some of these barriers, with the reduction of some of these random tariffs that are out there. There aren't anywhere close to these numbers shown here, but would still help reduce the deficits that we're seeing and might help American manufacturing get a little bit of a boost. So what's my take on this? And again, this is not investment advice. I am not a financial advisor. Please do your own due diligence. From an investing perspective, I did a video a couple of weeks ago that talked about how I'm basically at my cash max. I didn't like the uncertainty that this market presented given the valuation that we are sitting at. And this just adds to that. This is a lot more uncertainty to a market that's already rather uncertain. You're adding all of these tariffs that are somewhat all over the place based on trade deficits that might not be entirely driven by tariffs or anything that we can control. So we're just charging more for certain items. Will that mean that American businesses will either have to eat the cost, reduce their margins, or will there be layoffs? Will they increase prices, driving inflation higher? That's an unknown. While I do think tariffs can have some benefit if strategically targeted, this is very much a attack everybody and see what happens type of thing. And while I think there will be some short-term benefits, I think there's going to be some announcements around, hey, we're folding. This one country is removing all tariffs. This other country is removing all tariffs. I think there might also be some counterattacks from other countries that say, hey, you're putting a tariff on us. We're going to put a tariff on you, because a lot of these countries have free trade agreements with the US? And are we violating those free trade agreements now? Or are we just saying we're throwing those out the window? Everything is new because we're applying new tariffs to you. It seems like Canada and Mexico are remaining unscathed. But it's not just the tariffs that bother me, it's the wording that we're using, that other countries are taking advantage of us, that Canada should be a 51st state, that Mexico is sending nothing but drug addicts and drug dealers over the border. And that makes a lot of these countries just plain out dislike us. I've read a lot of stuff about boycotts from Canada, from the European Union, from Australia, from other countries, and that's going to continue. And if that becomes a widespread thing and suddenly American businesses are seeing their international revenue take a huge hit, that means that these PE ratios that are still in the 28x range, maybe 27x after the drop today, they're pretty expensive. And if this somehow leads to a recession, you have dropping earnings with a correcting multiple. Let's say earnings drop 10%, multiples drop to 20x. You're seeing a 30% price reduction right there. And that's why personally, I'm sitting at my cash max, and I'm not super excited about investing in anything right now unless something amazing arises. Because the last time we had a trade war with China, and this was just with China, this was way less widespread than this was, the market basically did nothing for a year and a half. It was either flat or mostly down for a year and a half until that was called off. And that didn't even include all of the other stuff that we're saying. This isn't just tariffs that are driving the negative sentiment around the US right now. It's all of the other stuff. Can other countries trust us as they had in the past? Or are we becoming too much of a wild card, and that will lead other countries to make their own trade agreements excluding the United States, which would be a pretty big negative? Because whether or not manufacturing has shrunk, and it has, and it would be good to bring it back, we have benefited a lot from the openness of the global trade market. The reason the companies in the US have done as well as they have is because they've been able to take advantage of the lower costs that exist overseas, and having to bring that back into the United States might be a benefit, but it might also be a negative in the short term, even if it is a benefit in the long term. So while I still think that the United States is going to be worth investing in, as with all things, we'll get over this, the market will start rising, and eventually, right now, the risk reward isn't all that amazing with all of the unknowns that are in here, with all of the potential boycotts, the tariffs, the unknowns that it comes that go into play with those. And I'll just, I'll do my typical weekly investments. I do my videos about here's portfolios that I invest, every Monday, every Wednesday. I have my 401k and all of that stuff. But beyond that, I'm going to kind of keep more money on the side than I usually would and see what happens and kind of wait out this process, because I think there might be opportunities to buy beyond what we're seeing today. So let me know what you think down below. Am I wrong on anything? Did I misspeak on anything? Leave a comment, like, subscribe if you're new here. And as always, thanks for watching.